Hey traders, Raghee here, and in this free recap video we're going to talk about a topic that I think is going to get a lot more attention in the coming days and weeks, and that is the next Fed meeting about what the funds rate should be. And there is a site that I recommend you heading over to, and that's the CME Group's countdown to FOMC, their CME Fed Watch tool. Now, if you just go ahead and type in CME Fed Watch tool into Google, it'll take you to this link. So just go ahead and Google CME Fed Watch tool. It'll bring you here. And there is a contract called the Fed Fund Futures that its sole job is to track sort of the bets being placed, if you will, literally and figuratively, as to where rates will be at the next meeting. And there really are only 4 meetings that mean a lot to the market, and those are the ones that accompany a press conference, and those are the quarterly ones, December, March, June, September. So December, not all that long ago, had a very, I think it was about an 80-some% chance of a rate hike. And then at some point today, it even dropped into the mid-60s until rallying back up here to the 70s. And there's been a lot of confusion, starting with Fed Chair himself, Chair Powell, and what he communicated by saying that we're very close to neutral, kind of the normalization of the rates. And then we have Fed member Bostic coming out saying, well, we're within shouting distance. Well, here's the thing. None of those comments actually say that the FOMC is done. In fact, it still implies maybe 1 to 2 more rate hikes to get us to just below 2 3/4 or just below the 3% mark. So again, is it 1? Is it 2? The market doesn't know. We're pretty sure that the FOMC is not gunning for 3 1/4. So I think that's where the 3 rate hikes has been taken out. And that's probably what caused a bit of the equities rally. So keep an eye on this to understand. Now, why is this so important? Well, if you're a dollar bull like myself and you're long dollars against the Canadian dollar, you're long dollars against the euro, this means a lot. You know, the fact that the FOMC will very likely hike rates, and this, again, this particular graph, if you will, this will fluctuate throughout the day, and it was much lower today. Earlier, it was like in the low 60s earlier today, so it popped back up to the mid 70s, and I think it's been closer to about 80 throughout the month. So there's still a lot of confusion about what the Fed means, and actually they don't want to tell us exactly what they mean, right? They don't want to pigeonhole themselves into activity. So they're always going to sort of hedge and never really tell you what it is they want to do. Now, if the equities markets are optimistic about the FOMC not hiking in December, they really should check themselves before they wreck themselves, because that hike is very likely to happen. In fact, the message that the FOMC would be signaling about the economy and the market would be actually terrible if the FOMC decided not to hike in December. And we go back to where the real question was, which is more of a 50-50, maybe worse today, expectation for the March hike. How do we look at that? Click right here, March the 20th, and you'll see the 2 graphs are kind of, more like 50-50, like we're just going to hold. And that's exactly, I believe, what the Fed wants to communicate to the market. December's a done deal, but what happens in March and in June, whether or not we go to just under 3%, or I highly doubt 3 1/4, that's going to be decided next year. That we're going to continue to monitor the data about. Watch the FOMC, this Fed funds rate, and what traders think the FOMC will do on non-farm payroll tomorrow. The FOMC has a line in the sand, by the way, and that's 100,000 jobs per report, and that was set by Janet Yellen back when she was the Fed chair. And as long as that number isn't too disappointing, there's very little reason that the market should A, sell the dollar off, and B, realign what they think will happen later on this month with that meeting. Okay, so what is it? The bottom line is, I don't think the equities markets are going to get some sort of reprieve, because it really isn't, by the way, with a hold from the FOMC this month, and dollar strength I think is here to stay. There might be some wiggles here and there, but I think buying into dollar weakness against the euro and against the Canadian dollar, and eventually we'll add the Aussie and New Zealand dollar to the mix. But for now, those dollar buys are working, and I'll see you in the next update.